Welcome, everybody, to our fifth edition of our 15-minute web series. My name is Ben Harmon. Partnering with me is Kate Flowers. We head up the education team at Arbor Financial Credit Union. And part of this series, we want to touch a bunch of different topics in the financial realm. We've done some budgeting topics. We've done debt consolidation. We're going to do debt consolidation this month. We did debt management in the previous months, budgeting. And so definitely keep on checking back as we update these topics all the time, which will give us a lot more insight for the 2021 calendar when it thinks about where we want to go financially. So jumping in, how much money can you save by consolidating your debt? I asked this to a lot of my members to sit down and actually think about how much debt they actually could save. And when you do add it up, the minimum payments, the things that you're doing to pay off that debt, it ends up being a lot, especially when you can compare it to the idea of consolidating debt, right? So when we think about consolidating debt, it's not that our debt just dwindles, it doesn't disappear, but what it does is it allows us to play the game of minimum payments or a more comfortable payment for us. So when you think about how much money you can save, there are a lot of resources out there that I recommend checking out. At arborfcu.org, under the Learn tab, there is a few calculators about debt consolidation, and I will also have a few examples later on in this webinar. So when you think about how much money you can save, consider that and where you want to be for 2021. Can you pay off all of it? Can you pay off some of it? Set yourself a SMART goal that's actually obtainable, realistic, measurable, and timely, and see if you can achieve to it. Maybe set it for a 6-month check-in so that you're not just, by the end of the year, I'm going to have this all paid off. Maybe have it to the point where you're actually doing check-ins monthly. Are you on task? Are you on top? Micromanage yourself. If you're tired of having this debt, you can get rid of it. I know you can. So when we think about debt, we always have to define the difference between good debt and bad debt, right? So not all debt is created equal. Debt does come from investments, and typically considered good debt are those ones that come from investments, like your house, even student loans, secondary properties. You might buy properties for the income from it. And then we look at bad debt, right? Bad debts are usually unsecured, the ones with the high interest rates, the ones that were not unforeseen circumstances. There are people that carry credit card debt that they had a medical emergency, and you can't help that. That's not your fault. Don't beat yourself up. We're all human. We make mistakes, but when we think about bad debt, hopefully it's not the credit card that was racked up at like Best Buy or electronics store, or, this is a big time of the year. And this is why I like to talk to a lot of my members beforehand. The Super Bowl's coming up, and I know sometimes we like to sit there and impress our friends, but do consider the long term and how much money that's going to cost you, right? And the biggest thing that we really want to touch base on, and people say, well, how much debt is bad debt? Like, do I have a lot of bad debt? These are great questions. And generally what we're going to start with is going to be DTI, right? So we got to assess our financial health and kind of where we're at today. I just had a conversation with one of my friends the other day, and he was talking about buying a house. And I said, oh, great. Where's your debt to income at? And he says, well, what do you mean? I was like, well, a lot of mortgage companies will only go to a maximum debt to income of 48%. And that's including the proposed mortgage payment. So where are you DTI? This is a very good number to know because almost everything is going to look at it. This is one of the major 3 parts of your credit report. But where do you stand? When we think about financial athletes, it's less than 30%. It is hard to get there. And I know a lot of times new home buyers, generally when they buy a new home, they'll be into the home for a couple of years and they're still, not want to say upside down, but still deep into the DTI, and they beat themselves up. But you do have to understand that you made a large investment, probably the largest purchase you're ever going to make. Your DTI is going to be a little whacked for a while, and the hopes is to pay it down and refinance, right? Generally, when people are buying first-time homes, they might get a little bit higher rate than they normally do because they have not much on their credit report, so the risk of the bank's offered that way. However, when we start building it down, people will get their house and they want to buy nice things for it. You want to watch the DTI. I mean, car companies, like you walk into a dealership, they'll go up to 90% sometimes. So they don't really care. It's really when it comes down to buying your house that DTI matters the most. Now, it does matter on a lot of things. People say, well, I get paid. How much credit would I get offered if I got a credit card? Well, that's going to compare with your DTI, right? So a lot of these places, it's all about the way their minimum balance is configured. Arbor's is 1.5% or $10. That's just an example. Every place is different. I know some banks have done 2.5% or $25, but you can definitely ask that to your financial institution. When you are consolidating debt, this is the one most important question that would make sense money-wise, because a lot of times when I help out someone save money, it's not like they just take that money. Like, let's say I freed up $300 for you, right? It's not that you necessarily take that $300 and then just dump into a savings account, you might free up other things. You might make your life more comfortable. You might do something that you actually more enjoy, right? Or maybe you just let that money sit there so you have a little bit of a nest egg so you sleep easy at night. Whatever you do with these things, it's called cash flow free up. And that's really the game in debt consolidation, right? So sometimes interest rates are less and we will definitely want to pay less in interest, but think about your monthly obligation, right? When we go from a credit card that's unsecured to a fixed loan, like a consolidation loan, or even Arbor's offering a 4.99 balance transfer for life. And so that means 4.99% of your balance will always be that, where most credit cards are 18, 20, even higher percent. So there are ways of consolidating your money. And it's not necessarily, I'm not going to say don't look at the interest rate, but the most important thing is the lesser of the payment, the cash flow free up. It'll allow you more money to make those decisions. And you can always pay more, right? There's nothing wrong. Most of these loans that you get nowadays, and I always recommend checking, there's no penalty for paying it off early. If you're considering a debt consolidation loan, get something that's a low payment. You can always pay more. And then let's say in a month of like holiday that we just passed where there's heavier spending, maybe you don't pay so much that month. You just pay the minimum payment. So when you're doing these consolidation loans, consider having that set up. But it's also cash flow. It's the cash flow, how much you're going to pay monthly compared to what you're paying now, and then interest rate. Now, I'm not saying interest rate is not important, but when you're already a lot in debt, even if you can consolidate your debt, you're probably getting half interest rates as it is. So definitely consider the payment. Now, when we look at different payment strategies, right, there are different ways of doing it. Some people use the avalanche method, which is pay off the debts with the highest interest first, or the snowball method, which you pay off the debts with the lowest balance. Now, I've seen both methods have their valid point, right? One is about paying the highest interest, so you're not wasting money in interest. Makes sense. The other one was paying off the lowest debt, so you can actually see progress in your debt consolidation. So one's money, one's more morale, and there's no wrong way of doing it, right? These are all great ways of paying down debt as long as you're managing it. You're gonna spend some money. Some people, they get on this interest rate hunt, and I'm not saying again that you should look at interest rates, but don't let it ruin your day. A lot of times when we're doing debt consolidation, you're going to another lender, you're saving 0.5%. That might be $200 over a 5-year loan. It's not that important to lose like sleep or your whole day of work or all these things people go through. And I know some people get so bent on that, but do look at what the payment is going to be, because that free up is going to allow you to do either a pay down more at a lesser rate, pay down other debt, or again, maybe have some savings account, maybe pay off something else. Maybe there's another repair or something that you need done that you need that money for. You don't necessarily have to save. Now, as a financial person, I definitely recommend having a savings, because chances are if we have debt, we've got there because we weren't so good at savings. That's okay. I'm not perfect either. But when we have an opportunity to save some money, we should always throw a little bit aside, because it's always better having something than nothing. I don't think there's any person in this world that would say, no, it's a bad idea having saved money. The only time it gets to that point is if you have a surplus of it that you're sitting on and it's doing nothing to work for you. So when we look at these debts here on the bottom, I got credit card A, B, and C. It ends up being about $19,500. And this is a good example. Now, this is using our numbers, and I wanted to show just relevance. This exists all over Kalamazoo. We're not the only ones. We do have a great rate, and it is 4.99 for life. But when you look at the payments, right? So the red one is what you would pay with a credit card, minimum payment, 17%, $145 a month, and you would pay 16 grand in interest. And that's an 80-year payoff. So that's usually what, if you have a large balance, you're paying the minimum payment on some credit cards, especially store credit cards. That's about the payoff it's set up to. Now, as you look down the list, if you were just to jump it over to 4.99, and that's not even at zero, but that does give you flex in payment. So see here, like you could do, if you could pay $584 a month, you're only paying $1536 in interest. Or if you did 60 months, $2573, or even let's say you did 10 years, you're still paying a little bit more than the 145, but you're literally paying a third of the interest. And think about what you'd do even at that price. If you had 11 grand more in money, what would you do with it? Now, again, that's not money that you're just going to have here. It's cash flow free up, right? But that payment, you're going to get 10 years, and then you're going to avoid 70 years of making that 145 payment. And there are a lot of calculators that you can do this. Look around. There's debt consolidation loans. Take advantage of balance transfers. There's a lot of different way of doing this, but when you think about it, most people, if they like balance transfers, this one's for life. Some balance transfers will be like 0% or 1.99% for a certain period of time, in which case you have to put a reminder to go in and switch it over to another credit card if you've ever played the balance transfer game. Generally, you'll pay a little bit of a fee. Right now, we don't have a zero transfer fee, and you will see that coming more common. There's a lot of places to be competitive with you to get your balances. They will make, either no fees or no interest rate, but it's the term. A lot of times you get 0% with a 3% transfer fee for 12 months. That's very common standard. And if you can every 12 months, or just say 11 months to be safe, log in, find another credit card you can balance that transfer to and do it, then you're saving money, but you're still paying that 3% fee on the transfer. Some people, the other option is just getting a debt consolidation loan, a simple interest loan. That it is they take all your balances, they put it on one loan. You have a set payment, and maybe it's more or less than the 145 that's here, but there's a set date, right? 4 years, 48 months. After that 48 months, you are debt free. It is done. There's no reborrowing. That's why I like sometimes having just a simple interest loan, or even like this one where it's a 4.99 lock, right? So that you don't actually have to reborrow. It's not tempting. You make some progress, because nothing better than finding that forward progress. So that's actually all I have today on consolidation, debt consolidation. We just again recapped how much money would you save if you could. We talked about the different types of debt, bad debt versus good debt. We talked about the two different methods of paying it off, and there's more. You can definitely look into it. And then we just did some money math to show the interest that you pay on a standard credit card versus even something simple like a 4.99 balance transfer, right? Well, thank you for stopping by. Hopefully you found this informative, and please check back soon for more tips and tricks on how to be financially fit in 2021.